Welcome to the SK Wealth video podcast. This is the first video podcast that we're doing, and I am Jason Archambault, CEO of SK Wealth Management, and I'm here with Matt Neyland, our Chief Investment Officer. Welcome, Matt.
Thank you.
You're welcome. There's been a lot of stuff going on in the markets this year for sure, and we were thinking about presenting this type of a video podcast so we could talk about the 5 hottest topics at the moment. So I'm just going to list some questions and then get some answers from you and your input and our take on things. So the first question is about navigating the April 2025 market volatility that we saw. April witnessed significant market turbulence, as you know, with global stock markets experiencing sharp declines following the announcement of sweeping tariffs by President Trump on April 2nd. Can you elaborate on the primary factors that contributed to that volatility and also how our investment strategies are adapting to those changes?
Sure, it's been dramatic to say the least. I think what you're seeing here is a result of that dramatic changes that we've been seeing here in the markets. There's some things that have happened very quickly. There's some things that have happened that nobody really predicted was going to happen. The world looked like it was going to be fine post-election. Everybody felt good about things. But as the year progressed here, mainly as we got to that mid-February point, and there was more and more talk about the emphasis of this new administration was going to be on trade wars and tariffs, that changed the dynamic in the markets pretty dramatically here. First, this is a view of the stock market. So you can see there's 4 different components of the stock market I wanted to show here. One is the S&P 500, which is the white line. The NASDAQ index, which is more geared toward growth companies, particularly leans more toward technology, software, communications, you name it. Then I put in there the U.S. Large Cap Value Index, because that's a little bit different. It focuses on companies that are not as much in growth mode as they are about just steady growth. So think of things like healthcare, banks, materials, some of those different categories. And I'll show you in a second here why I included those. And then the last thing I wanted to include was the international stock markets, excluding the US, which is the red line here that stands out pretty dramatically. But just to put things in context here, when those tariffs, so-called Liberation Day happened, we saw a dramatic reaction in the markets. Why did that occur? It occurred because financial markets and investors look ahead to what potentially is going to happen. And in this case, everybody's looking at if we are really using unilateral tariffs and some higher, even higher than that baseline rate, there could be a dramatic impact on future economic growth, therefore hurting financial assets. But what is interesting in this picture is it wasn't just all the same. Yes, everything went down after Liberation Day, but they went down to differing degrees. You can see the areas that really suffered the most was the winners of the last 10 to 15 years, the NASDAQ and growth companies. They fell the furthest. As a matter of fact, intraday, they had fallen 25% from their highs, which was just incredible. And as you can see here, they settled in at the close down just over 20%. Whereas the S&P 500 at one point in time during the day touched down 20%, but ended up closing down about 15% on the day. And then you look at what's happening. You look at the yellow line. These are value companies, and they did not fall as much. International stocks did not fall as much. These are things, especially the international markets, that nobody had really anticipated. Because theory goes that, hey, if there's a trade war, the bigger economy's stock market is going to win. But in this case, because they opted for unilateral tariffs across the globe, even with countries that we don't have a trade deficit with, it really shocked those markets, but it spurred investors to start thinking about who could be winners in this type of environment. And so there was a rush to buy international stocks. But then the thing that's also dramatic here is the recovery. Here you can see how V-shaped it was. I talk about this a lot. When we have dramatic moves down in the market, many times they're closely associated with V-shaped recovery. So it really hints at the whole trying to time the market and the fallacies of following that type of an approach. But as we sit here today, you can see that a lot of the U.S. markets, stock markets, are down still to this moment, even after today's rally. And international markets are up nicely. They're really crushing U.S. markets. And those value companies that have been laggards over the last 10 to 15 years have risen up and have, in a lot of cases, positive returns. So it's a real, interesting dynamic here. The other thing I'll say about this, which is, interesting, just to go back in history a little bit, when COVID hit, everybody, and then over the next 4 years, most economists and market strategists and so forth were continuously calling for a recession. A recession, as we know, never came. This time, economists, business leaders, and everybody is saying, there's a really good probability. Right now, it's about a 50-50 probability that there'll be a recession. But the markets seem to be ignoring that information. And I think that is, a very different in this standpoint, because as we'll talk about as we go through this, there are some other things that people and investors really need to think about here. The last thing before we go on the next one is I wanted to show you what's happening here in the international, in the bond market. I mean, that's another area that a lot of people were not anticipating that would happen. And that is the wild ride that you're seeing here on this chart in Treasury yields. So the bond market has been going crazy. I'll talk more about it a little bit later on here. But as you can see, this type of a picture this is the 10-year U.S. Treasury yield. It's the one that's priced, that mortgages tend to be priced off of. It's a baseline for a lot of corporate bond pricing and other bond pricing across the globe. So it's a good proxy of what's happening with interest rates. And you can see that, you start off the year, interest rates, went up a little, then they came down quite a bit, and worries about what was going to happen here with the economy, because interest rates tend to go down when the economy weakens as investors rush for safety. But then we see the dramatic increase post-Liberation Day. It was one of the biggest spikes in yields that we've seen in history during that period of time. So it just shows the amount of uncertainty that just is going through all these different markets. But the conclusion here is, at least for this period of time, is that most fixed income categories, most bond categories have survived and have held their value, or up a little bit, or maybe down just a little bit over this period of time, but they have stepped up and been decent diversifiers in this environment.
Two follow-up questions. Why do you think the markets are ignoring the recession signals of perhaps 50-50 chance of a recession?
There's parts of me that think, they'll try to think logically, and then there's other parts of me that say that, burn me once type thing, where everybody was calling for recessions for so long and trading and managing portfolios that way. They're saying that now, hey, if it hasn't happened, why does it have to necessarily happen this time? They may be right. But I just think that there's a little bit too much of this Goldilocks feeling that everything can be all right, and that maybe the Trump administration will be rapidly backpedaling on some of this policy, and we move on to other better times going forward, and the administration focuses on the things that they really talked about: deregulation, tax policy, and so forth.
Sure. Yeah, we'll see what happens.
Yeah.
When we look back at that volatility, both in the stock and the bond market, when we think about our portfolio construction, I know we've been preparing for something like this along the way, but I think a lot of our clients have been asking us lately, what are we to do about it, and how are we addressing that?
Yeah, there's two ways to think about that. Number one, and the markets are very forward-looking, so they are reacting ahead to future expectations of outcomes. And so to make adjustments in, I say, the eye of the storm is generally a bad idea. You really need to be prepared for and make adjustments ahead of these events. Last year was a big year for us because a lot of things going on. It was in elections all over the globe, changing policies, changing consumer and investor sentiment. It was all over the place last year. So we were very busy, as they say, in the laboratory, running a lot of scenarios about potential outcomes and things that could happen here. And one of the big topics was that odds became greater. The Trump administration was going to win the election. Is that we really focused on what would happen in these scenarios. And we were really looking at things that areas that could be affected, but also areas of opportunity. So last year, leading up at this and early into this year, we looked at things, where was the highest risk to this environment? And one we saw was smaller companies. Again, of something that turned out that the myth did not become reality, that small companies, usually people say that, oh, they're buffered from trade. They are not buffered from trade at all. About a third of imports into this country go to small businesses and small publicly traded companies. So they are right in the crosshairs of this, and I would argue in some ways more susceptible. So we started trimming back on that area of the portfolios. We also looked at currency. Because as we're seeing here, and I'll talk about more later, is that currency has become extremely volatile. The whole world is trying to reimagine, trade and how trade is done. And remember, trade has to be paid for. You either pay for it in your local currency or you pay for it in some other currency. So we've seen currency fluctuations just be dramatically wild. So another big theme for us is we hedged out a lot of our currency exposure, because currencies, where there's opportunities, there can be, but they can also ruin a good thesis. You could buy a foreign country, they could have nice growth, but then you top on that, the currency effect, if it's negative, can take away that performance. But the other thing that we did there is we added some fixed income strategies that can take advantage. They can also hedge, but they can also take advantage of where they see currency dislocations. So that's been a big thing for us as well. In addition to, things like areas we looked at that could limit downside risk, adding in alternative strategies, hedging strategies, adding in some commercial real estate because valuations got so low. All those things have really been very beneficial to help us get through this, wild environment that we're in.
Great, thanks. Next question. This one actually deals with the implications of the Federal Reserve's recent decisions. So the Federal Reserve recently decided to maintain that interest rate of 4.25 to 4.5% with all this economic uncertainty going on, influenced obviously by the recent trade policies. So how does that Fed decision impact our economic outlook, or does it, and our investment positioning moving forward?
Yeah, good question, and perfect timing since the Federal Reserve just concluded their latest meeting yesterday. And it's really, I need to set the stage here for what's happening. Because one is to say, what is the central banker's goal? It's really, they have a dual mandate. They want to maximize employment and they want to stabilize prices. So they are in a tough spot right now because of what's happening here. And you even heard it from the chairman of the Federal Reserve, Jerome Powell, yesterday, that it's very difficult to make changes in Federal Reserve policy in light of this environment that we're in, filled with uncertainty. And that's where we are. But let me set the stage for what I think is going on and how we're reacting to it. One is, since these tariffs hit, we have seen inflation expectations surge incredibly. I mean, look at this chart. You can see right here in blue. This is expectations for future inflation. This is higher than it was, heading into 2008. It makes COVID look like just a minor experience as far as inflation. Will this come to reality? We don't know. There's a lot could be changed here. But think about that if you're sitting in the Federal Reserve seat and saying one of your mandates is stable prices. How can you cut interest rates? Even though the White House is beating them up every day, including today, why aren't you cutting interest rates? It's tough to cut interest rates because it could further stoke this inflationary environment, which therefore could have, a detrimental impact on overall growth. But also, other things to think about. Tariffs right now have changed the forecast. I touched on it before, but a lot of the forecasts here now are calling for some form of negative growth here. Whether it leads into a recession, yet to be seen. But what we're seeing here now is this is forecast and impacts what would happen if this continued along this line of tariffs and essential tax hikes that would occur. We've already seen the initial stages of it. Last week, we got first quarter GDP numbers and it was negative. Some people are anticipating that, other people were surprised. But I think what you're seeing here is a setup for the impacts that can happen. And as you can see from this chart, declining growth, doesn't necessarily turn on a dime. Sometimes it's just a slow grind downward over those periods of time. So this is the other side of the equation for the Federal Reserve. They're saying that, wait a minute, we don't want inflation to reignite, so we're worried about cutting interest rates. But now we're starting to see weakness in the economy, which normally we would respond to cutting interest rates. So it puts them, as I said, between a rock and a hard place here. Right. And what you're also starting to see is the impact on expectations of corporate earnings across the globe. What this is showing is this is forecasted corporate earnings growth, and just about everywhere it's anticipated that both in 2025 and 2026 they're going to be lower than they were anticipated heading into 2025. So that's another thing that another clue that the Federal Reserve is looking at and saying, wow, that maybe things are not as simple here, or maybe we've got to do things in a very cautious approach here not to cause any problems. So what has happened now is the Federal Reserve they announced, give an indication, I should say, about what they think is going to happen with interest rates, what their policy is going to be. And remember, they can only control short-term interest rates in this environment. But we were coming into 2025. Everybody was feeling good about where the economy was, that inflation was coming down, and they had announced that they expected 4 interest rate cuts in 2025. Well, bring on the tariffs, and we suddenly are back to where expectations now are really that there'll be 2 cuts in 2025, and they will happen in the later part of this year. Some of the market participants have been pricing in through the futures market 3 cuts, but even all 3 cuts, if that's the case, would it happen in the fourth quarter of this year? So we're still in a situation where short-term interest rates can stay higher. And that to us is opportunity. We look at this and we say in client portfolios, wherever we can in cash, let's take advantage of these short-term rates instead of just leaving it in plain cash, which we were getting like 0.4% yield. We can get over 4% yield if we use some of our high yield money market strategies in order to achieve that. So for an extended period of time, we're still in a situation of, hey, you can put some cash aside and get paid for it in this environment. Some of the examples of things we've done too, some clients have said, could you take all of our cash needs for this year and put them into these money market strategies so we don't even have to worry about it? It's easy to get it, no volatility. Others have just said, we'd like to, we have some upcoming expense. Can we make money? Should we wait to the very end? And now we have options for that as well. It also is having ramifications on longer term interest rates that we're taking advantage of. Right now we're getting, like last year, we got returns just out of interest income alone in the 6 to 8+% range. I see this environment extending for a long period of time here because of the fact that interest rates, I think, are going to be locked in a range for a while. So it's definitely changed how we look at things and where portfolios are, and how conservative portfolios and aggressive portfolios are coming in closer alignment with future expected returns that we've seen in almost 20 years.
Right. You're right. The trends certainly have changed, and we're adapting to that as well. I think one of the other trends that might be changing is the alternative space. When we're talking about not stocks, not bonds, But there seems to be a surge that we've seen in alternative investments. I know we employ some of them ourselves in our portfolios, but despite all this volatility, they've seen a notable increase in sales for these alternative products in the first few months of 2025. What do you feel are some of the factors that are driving that trend? And how should investors consider incorporating those alternatives into their own plans?
Yeah, it is a very interesting trend that's happening. There's been, as I say, it's almost like brand warfare now. As everybody's racing to try to come up with options and look at different ways that they can incorporate more markets, more type of strategies, more asset classes into client portfolios. And, some of them that were always reserved for just the ultra rich or pension plans, endowments, or big corporations. And now they're really trying to democratize that and bring that down to the public. I would say 5+ years ago, I really started to look at and say, you don't always have to manage portfolios the way it's always been done. You can think about different ways. As long as you're looking at different ways and different inputs, there may be different outcomes that you can generate here by incorporating things like alternative strategies. So it's been a big push for us in portfolios to do this. And I'm going to show you why that this is, because a lot of times, picture, it really tells the story here as far as,
Right.
these situations and why we have decided to add alternatives into portfolios. Because as you can see here, adding alternative strategies into different weightings across different portfolio types has proven to do two things. One, it has helped lower risk, lower downside outcomes. And it has actually helped to improve returns over different timeframes. And this is something that's very significant. It's something that we looked at quite a bit. We were testing this and we're saying this makes a lot of sense to us. So that's why you've seen the amount of alternative strategies in our portfolio go from 0 about 5 years ago now to 15+% in client portfolios. This example is showing 20%. I can see us getting to 20% sometime in the near term because these are the type outcomes that we're looking for. Even in the end here, you're looking at the very end. This is looking at just a traditional 80% stock portfolio and 20% bonds. You could get almost identical return profile with having 60% equities in the portfolio if you're adding alternative strategies. That is a big thing because it means that you could get the same outcomes with a lot less risk in portfolios, particularly downside risk in portfolios. And I want to show you a real example of how this happened very recently. If we all, I hope you forgot it, 2022 market, when just about all markets went down, this is what was happening. In your traditional portfolios, you had stocks and bonds in there. And if you look, with stocks down 19%, bonds down 13%, there was no happy players in that environment. And the thing that really stood out, and this is something we've also been seeing, is that some of the traditional bond categories were not providing the diversification benefits that they normally do. Another reason why we looked at alternatives. So look at alternatives. In a horrible market, they held their value and actually gained some value in one of the most dramatic market environments that we've seen in quite a while. So it really highlights how we look at things in a little different way. We always looking at saying that what we're doing today may not be the best going forward, but we always want to test and find how we can achieve the best outcomes in portfolios.
Yeah, that makes sense. And I think it's pretty interesting to see that visual of being able to add the alternative piece into a portfolio and see the risk go down, but the returns go up. Or in the most aggressive portfolios, the risk go down and the returns remain the same, which is pretty interesting. All right. I have the next question for you, and this is switching gears a little bit, but it impacts portfolios for sure and the economy, but it's analyzing the impact of the recent corporate layoffs that we've been seeing. In fact, I know yesterday there were a couple more that made the news. So several major corporations, it's been Meta, It's been UPS, Morgan Stanley's in there. They've announced some pretty significant layoffs for 2025. So what do these workforce reductions indicate about the broader economic landscape? And also, what implications might they have for investors? Is it simply an indicator of going in more towards a recession, or are there other indicators that might prove out to be?
Yeah, so in some ways, the job market can be a good bellwether for expectation of what's happening. Some companies, like we've seen some recent layoff announcements, some companies front run it. I think it can be a little bit similar to what happened in COVID. Some people take advantage of the economic expected weakness to front run and start doing layoffs ahead of it. Other companies are more reactionary to seeing what potentially could happen to the economy and therefore their businesses before they make those decisions. But let me show you an interesting view of things, how this is playing out.
Right.
As I mentioned, going into this, business leaders, economists, everybody was going to the White House and saying, please don't do this, be more careful, be more tactful, as far as how you're going to, implement this and try to right some wrongs that exist in the trading world. But what's happened here is it's interesting. When you look at, it's interesting, listen to first quarter earnings reports. A lot of companies now are not even offering forecasts. That's highly unusual. We saw it in COVID. We're seeing it again now, because how can you plan? How can you say what you're going to do in an environment where it changes by the minute? So it freezes them as far as decision making. So the first leg of this, we've seen some layoffs, but I think the bigger first leg of this is that we're seeing freezes in hiring. Companies are just saying, we can't do anything right now. We need a clearer picture. I think another thing that's interesting to look at, and you can see it on this chart, is that look at other periods of time. When you had dramatic things happening in the economy, you could look at the tech crash of 2001, you could look at the great financial crisis of 2008, and COVID. The dramatic change in the dark blue line of employment numbers. Unemployment numbers went up dramatically. But we've been on a steady improvement, getting back to pre-COVID unemployment numbers here. They've ticked up just a little bit recently, but in general, sitting at 4.2% unemployment where we are today is some ways considered, almost like perfect unemployment. I know that sounds weird, but from an economic standpoint, meaning that that's a good unemployment number. It's enough that there's people looking for jobs, and there's enough people employed to maintain a steady economy. But the other picture here is, excuse me, and you can see it in the blue line, is expectations of hiring in the near future. And when the election happened, a lot of companies were getting ready to expand because there was a lot of pro-growth talk that was occurring in that campaign. Now it's completely reversed. You're seeing expectations for hiring just drop dramatically in a very short period of time here. So this has a lead-on effect to, let's face it, if people aren't getting hired, if there's layoffs and so forth, it's a trickle-down effect. I kind of talk about this, and kind of what's happening with the tariffs is kind of a slow motion plan. This isn't something where we just woke up and there's, disaster, a housing crisis, a tech crash, all these stuff, COVID hitting. This is a slow motion decline that can be occurring in the economy. And just to give you an example, I track shipping, one of the weird things I like to track, but I like to see how this all working. And it takes between 30 and 50 days for a container ship to be loaded in Asia and arrive in a West Coast port. After that, then it either gets delivered locally or it gets on trucks or trains and gets dispersed, across the country.
Yep.
So you're not talking about something that can be stopped immediately. It's not like suddenly there's going to be a massive build out of container ships and things going on, and suddenly a magical way that goods can be transported more quickly. And another thing to keep in mind is tracking shipments out of China to the United States, which obviously we import a lot of goods there. Those shipments have dropped 65% in a matter of a month or two. It's been extremely dramatic. And it's, again, not something that you can get that back very quickly. So all this can lead to, like, that trickle down effect of, hey, we can't get these goods out. The people who sell those goods could be hurt. They could lead to layoffs. People could track their spending. It's a circular thing, that where you could get that damage affecting the economy.
Yeah, we'll see what the future holds on those things for sure. And then the last topic today that we wanted to talk about was understanding the recent bond market sell-off. All the news every night always pertains to the stock market. We don't hear about the bond index and what it does during the day, but that stock market downturn that we saw in April, the bond market also experienced a significant sell-off with those yields spiking to those highs, as you showed on that earlier chart. What factors contributed to this, what we would pretty much call an unusual movement for those bonds, and how should investors interpret those developments?
Yeah, this is a one that's interesting. All the talk about trade wars and tariffs really focus on the products and services that are sold across countries. What a lot of people don't talk about is the most important thing, the plumbing of the financial system. And what I mean by the plumbing is anytime a country wants to, buy a good from another country or sell a good, they basically have to make a decision. And most trade in the world is done through US dollars. About 80% of global trade is done with US dollars. So you'll hear the term, the US dollar is the reserve currency of the world. That's come down a little bit, but still, it's hard to change something like that. So let's walk through a sequence of what generally happens. So a foreign company is going to buy a good in the US. So what they say is, well, we'll need dollars to do that. We'll buy US dollars. We feel good about it because the US has always been a stable economy, a safe haven. And then with those dollars, until we spend that money on the goods, we will buy US Treasuries, again considered one of the safest assets in the world, and hold those securities, those dollars in Treasuries. So that's a normal thing to do, and it's been beneficial for the US because the dollar has been generally strong, and interest rates have been generally attractive versus other parts of the world. But lo and behold, this period of time is a bit different when we look at what's happening here now. This is a one-year chart showing the white line is showing the US dollar's value over that one-year period. And then I brought in that Treasury yield movements here, and then I expanded out to a 1 year because I think it even shows more dramatically what's happening here, how volatile Treasuries are. But what has happened here now is that a different picture. As you can see where the dollar has kind of been surging since, when it became clearer and clearer that it looked like Trump was going to win, and that they thought that he was going to do some form of tariffs. Usually the safe havens, like the US, is where investors will go and they'll do what I said. They'll buy dollars, keep it in treasuries. So that was a normal pattern. But it's all been flipped on its head this time. The dollar, because of what everybody's worried about, that the stability of the US, believe it or not, and trade partners are looking at and forming partnerships around the US, the use of the dollar has come down. Therefore, the value of the dollar has come down, and there have been less purchasing of US treasuries. So it's been the opposite effect that a lot of people thought would happen here, which has been pretty dramatic. So if you look at why also what's piled onto this, if you think about an investor that did what I mentioned, buy US dollars, buy US treasuries, what's happened since the beginning of the year is the dollar has dropped about 9% in value. What that equates to for those countries and companies holding those US treasuries, they lost 2 years of interest value. So it's like, whoa, we can't continue along this line. So there's been a dramatic selling of treasuries from foreign investors. And this goes to individuals. I even saw an interesting statistic how individuals in Japan have been selling their US treasury holdings because they're nervous. But what it means, though, is for portfolios and things to think about the ramification is this can change the dynamics. It's why we're looking at even expanding our international stock market exposure because it's creating opportunities in other places. Currencies outside of the US, are going up. interest rates are becoming more attractive than just going to the US. So we're seeing a lot of different opportunities that are cropping up in other places that you wouldn't have thought of and when this whole process started. So to me, it's exciting because I think that when we look at this, events like this, in my mind, have changed global trade forever. It's not, you can't put the genie back in the bottle that easily here. It's going to take time, and I don't see countries and foreign countries changing their process and just saying, okay, all's clear going back. I think it's more likely they're going to say, let's look at some permanent solutions to how we do trade, whether it's, nearshoring or changing your trade partners. So a lot of different things. So there can be some really interesting opportunities here that can be derived in this new environment.
Interesting. Yeah, because like I said, there's been a lot going on in the last month or so. So we figured we would put this out as our first video podcast for Hot Topics. And thanks, Matt, for putting that together for us and answering all those questions. We're going to continue to have these Hot Topics podcasts, video podcasts as needed as we go forward. And we will be addressing all the new issues that may come up in the future as well. So thanks everyone for watching, and we will be in touch soon. Thanks again, Matt.